Emily is worried that there aren't enough bears about, and that this market has lost its bearings, if you get the joke. Emily, thank you very much indeed for your time today. We've had record high after record high. We're a little softer today, but if we have 9 days higher, we haven't seen that since 1964. Apparently, that was when the Beatles were in charge of the charts. Emily, how big a problem is this? And what do you think about these markets right now? Are you comfortable with where we are, or are you worried actually we're setting ourselves up for disappointment?
Well, thanks for having me. I'm still a little bit worried about the fact that you're not a Beatles fan guy, but I think we'll have to come back to that one later on. So, I think what's interesting about this market right now is that it does have a lot going for it. The economic data has been surprising on the upside. Last week we saw U.S. services PMIs at a record high. We saw the U.S. economy add over 500,000 jobs with significant upward revisions to previous months. And the fundamentals look great as well. Q3 earnings season really couldn't have been better. 39% year-over-year growth, reflecting this really strong demand backdrop. And then you've got some significant risks that are fading. COVID certainly is one. We've got these new treatments announced. We have kids now being able to get vaccinated. Higher taxes are fading as a risk at the margin as this infrastructure bill gets watered down. And then finally, you've got a ton of cash on the sidelines that's looking to get deployed. The challenge is that we're starting to see these pockets of speculation building again. You've got small cap stocks ripping. You've got, meme stocks coming back into the narrative. And you've got bears really starting to capitulate. I've seen it significantly on Bloomberg over the last few days. Some of those bears that we've heard from over the past few months saying that they're waiting to buy the dip. They're not waiting anymore. If you looked at the Bank of America fund manager survey a month ago, investors were bearish both stocks and bonds. And clearly, that was wrong. So when we think about our view heading into next year, it's really about, don't get too comfortable in the fast lane. Don't overreach for risk in this market. And in fact, we think it's going to be important to be more thoughtful about where and how you're invested into next year.
So, Emily, does that mean that you want to sell rips and then put some cash on the sidelines and then buy the dips?
We want to sell areas where there is, speculation. We want to sell the highest, most cyclical areas of the market. We want to fade things like commodities as we head into next year. And we want to embrace quality. We want to look for stocks or sectors that have great balance sheets, good return on equity, great earnings prospects as we head into next year. In the previous segment, there was a conversation from Abby around valuations. And, we tend to look more, of course, the PE ratio has a numerator and a denominator. The numerator is prices. The denominator is earnings. And we think the denominator is more important. And when we look out into next year, the quality growth sectors that we really like, areas like technology and communication services, are showing the best earnings growth prospects, along with some higher quality cyclicals like industrials. When we look on the value side, those earnings growth prospects are actually starting to fade. The financial sector is showing negative earnings growth for 2020. So we want to be very mindful of that. We just want to notch up on quality. We still want to embrace equities. This is not an overly bearish message, but as the economic growth backdrop slows, you want to be more careful about where you're invested.
So you still want to embrace equities. Let me ask you, therefore, the question that I asked Kate Moore yesterday. Her answer was absolutely. Do you want to be fully invested at this point?
You do. We continue to embrace value and growth. So you want those higher quality value stocks. You want to own growth stocks. You want to also have a balanced portfolio. You hear a lot, and I know it sounds boring, but you hear a lot of folks talking about sort of, the death of fixed income. You don't want to own bonds in this environment. We actually think that you've got to own a combination of higher quality bonds to offer that buffer if we see volatility next year, which we do expect. And you want to pair that with corporate bonds, particularly in the BBB and the BB space, in order to capture that additional yield. So we still think that equities need to do a little bit more of the heavy lifting here. We want to own bonds in that intermediate part of the curve. There's great roll down potential there. Where we don't want to be, Guy, is in cash. Cash is simply going to be a very, very inefficient asset class. The Fed, we think, is going nowhere. We think rates stay lower for longer. And right now, of course, you're losing money if you own money market funds or cash, where, frankly, a lot of the flows are actually going.
Hey, Emily, before we let you go, we started talking in the show about Lyle Brainerd versus Fed Chair Jay Powell. The excuse for the rally in the bond market yesterday was that we may get a Lyle Brainerd Fed chair. How do you factor that in? How much do you care about the two, between the two of them, who leads, and like how does that affect any investment decisions you may make?
Yeah. Well, I wouldn't overemphasize that as a key catalyst for the market. And first, just to answer the question around bond positioning, you know, we look at the rally that we've seen in bonds as just a shift in positioning, as investors were overwhelmingly positioned prior to the Fed meeting for rates to back up. And those positions needed to be unwound. And that's one reason that we think that we're seeing this rally in bonds. As far as the decision between Brainerd and Powell, probably won't put much of a dent in markets. As we've just talked about, not much can right now. So we don't think that that event will cause significant volatility. The challenge for if we do see significant turnover on the Fed, which regardless of who the chairman is, we are going to see significant turnover. This cycle is moving quickly. This is a new Federal Reserve that could get put to the test very, very fast. And we've seen with Powell that sometimes it takes a little bit of runway to get that communication just right, to get that messaging just right. And that could be a challenge as we have a more kind of junior group of Federal Reserve officials into next year at a time that the economy is slowing and if inflationary pressures potentially need to be snuffed out more quickly.